Yeah, all right. Hey, everybody. TG Watkins here. We've got a few other of our other traders online as well. And we'll just be taking the next, I don't know, few minutes, however long we kind of feel like the conversation is going to be going for us, and talk about some of this stuff. And I really appreciate y'all tuning in. So if you have any questions, feel free to check us out over at simplertrading.com. And I imagine a lot of you guys are probably already subscribers, so it's good to see you guys again. As far as the Silicon Valley Bank situation, there are a few components. I'm sure Sam and Danielle will be ready to fill me in on some of the details if I've missed them or gloss over some of them. But what's happening is we've had a rapid raise in interest rates. We all know that. We know that the Fed has been doing to try and address inflation. And the problem with that is it's created some mismatch for banks like this. For Silicon Valley Bank in particular, they had a lot of money tied up into 10-year bonds. And so what happened was, imagine this. They're going to say, we're going to pay you more money, but we're going to only pay you once per year. And you're like, well, I got bills to pay. I mean, it's great that you're going to be paying me more money for my salary, but I have to pay my mortgage and my utilities and all this stuff, and I need more cash flow. And so it was kind of something like that that happened for Silicon Valley Bank. A lot of the money tied up in 10-year bonds, they would have made money on them and everything would have worked out fine. But the problem is that now, right now and over the last year, a lot of their depositors have been needing their money. They have cash flow, they have cash burn. A lot of these were startups or tech companies and companies that needed payroll. They needed to pay this, that, and the other thing. And so they were drawing money from their bank accounts. And Silicon Valley didn't have enough cash. And then one thing kind of led to another. And there was also on top of that, that basically the venture capital funding and investment in all these companies started going belly up because going into 2022, it was a bad year, bad era to invest in startups. And so money coming into the bank and the number of startups starting basically just dried up. So it was kind of like a 1-2 punch for Silicon Valley, and it snowballed. And then word apparently started getting out, and I guess all the companies and VCs instead of each other started texting each other, and basically they all did a run on the bank. It's like, oh crap, we hear there's bad stuff going on, and we need to pull our money. And so now it was a third thing that started snowballing on top of this, and they just couldn't pay their obligations and their debts. And so that's when everything kind of blew up, and finally this happened. So Sam, do you have anything to fill in on that?
No, I think that kind of covers it. Yeah, the only thing I would probably add is that the assets that seemingly got them in trouble are risk-free government debt. So it's a little bit different than what usually gets banks in trouble, which is, a bunch of really dumb, risky bets. This was all kind of, well, they bought treasuries and bonds at very low interest rates, and when interest rates go up, um, they basically take losses, right? So it's not a big deal. If you can hold it to maturity, then you could just get your money back in the interest, and it's not a big deal. But it is a big deal if people start asking for their money back and you don't have it, and then you're forced to sell those assets that you were planning to hold to maturity, and you have to sell them at a big loss. And then, obviously today we got the Credit Suisse news. And, it's anyone's guess what happens there. But really, historically speaking, if you look at 2007, 2008, there's multiple rescue operations that don't work. So they're coming on pretty fast and furious. We got one on Monday for the depositors of Silicon Valley. And basically, within a few hours, we got another rescue operation for Credit Suisse. But from a trading perspective, if you're bearish, you really kind of should welcome that, because that'll give you a pop to short into.
Yeah, now with all of this, there's been a lot of contention going around there about this being a bailout for the banks. What is your stance on that? Because it is interesting to see that this, as you said, this isn't necessarily because of the banks getting into overly risky stuff and doing all these derivatives and stuff. It's really kind of a function of interest rates exploding, going up so quickly, which on the other side, one thing I'm wondering is why didn't the people who were actually running these banks, why didn't they see this coming? Why didn't they know that this was going to be a problem, and why couldn't they hedge or to get rid of them sooner or start coming up with other game plans?
Well, Silicon Valley Bank didn't have a chief risk manager for 8 months. They just didn't have anybody even in that position. Really what it comes down to is just hubris. I mean, it's the same thing, human nature never changes. So it's the same story just with different characters told over and over again. So it's hubris, right? They thought that it's risk-free, right? So no big deal. It's, government paper. So what's the worst that can happen? And so they overextend themselves, right? And basically it's the old adage of picking up pennies in front of a steamroller, right? They're trying to get this little extra bit of yield, and so they lever up and they overextend themselves, and they are able to hide the risk from themselves in a lot of ways. And then when the risk is realized, it's already too late.
Yeah, very interesting to see that people were trying to maybe do the right thing, buy government bonds, and be safe with it. But the inverse relationship of the price of a bond to its interest rate, and now we had interest rates go from 0 to almost 5. That's a huge move, and the Fed has been basically looking for signs of something happening. They talk about the delayed effect of this, and here we are, finally starting to see the effects of this, and it happens with things first gradually, then next suddenly, and all these things are starting to blow up. And we've seen what the Bank of New York, Credit Suisse, and now that's a thing because don't the Saudis have some rule or regulation that they can't be more than, I don't know, 10% shareholder or something like that? Is that what I read correctly?
I don't know if it's the Saudis necessarily. I would imagine that's a European rule because they own like 9.9%. I think if they were to cross the 10% threshold, that puts them into a different bucket. But one thing to consider is if the same dynamics start to affect European banks that affected the Silicon Valley Bank, European banks have been buying bonds at negative interest rates for years. So if Silicon Valley Bank got in trouble for buying bonds at 1% and 2%, and then bonds go to, treasuries go to 5, well, European banks have been doing the same thing, but they've been buying it at negative interest rates. So the time bomb is actually really Silicon Valley Bank's kind of a diversion. We really should be focusing a lot more on the European potential for contagion.
Well, I mean, if you even look at Credit Suisse, it has been in a downtrend. Gosh, I mean, we could even say since I'm looking here, it crossed underneath, and this is a line in the sand that I like to use. So I had a market update webinar a couple weeks ago, and a lot of what I was talking about was the monthly 10 SMA. And we can see that Credit Suisse got underneath its monthly 10 SMA around April 2021. And then it traded sideways for a while, and it looks like something around January of 2022, again, that's when all this kind of started, that's when it really in earnest started its downtrend, and the volume has been increasing ever since. So it seems as though, according to the chart, this wasn't any kind of surprise that came out of nowhere. It seems that people kind of knew this, and nobody was really willing to do anything about it. It's interesting to see that, oftentimes the charts don't lie on the bigger picture, and we've been also seeing that with the KRE, which is the ETF for the regional banks. It too got underneath its monthly 10 SMA around April 2022, so a little bit later, and then it has been in a sideways to downtrend, against the downtrending monthly 10 that whole time, and then it just dropped.
Yeah, Credit Suisse has been in. This isn't their first rodeo doing shady things. They've been in the crosshairs for quite some time. The other one to look out for would be Deutsche Bank, so DB, and then potentially if it goes to Asia, then HSBC. So, those are potential things that we should be looking at. One thing that popped up in the session earlier today when I was doing the close was in terms of American banks and American Big Four, Wells Fargo. Wells Fargo is looking like a really juicy short on any kickbacks to resistance. If you look at the weekly chart, it has a weekly squeeze, nothing but sell signals, and a giant weekly bear flag. And if the bear flag plays out with all the signals, it's a $40 stock today. I think the target would be closer to 20.
And it's definitely visited that before. So now WFC is the ticker for Wells Fargo, and One thing I would kind of want to add some context, just because this thing might get to 20, is now the best time to be getting in short on something like this, or what is some of the nuances and structure that we should be looking for in order to get into something like this if it's going to continue short?
From a technical basis, I would just do everything like you normally do. The one thing that I would say, just having traded through 2007, 2008, is we're due for kind of a big, hopeful relief rally. Maybe it'll happen overnight to tomorrow, based on the European stuff. But if it does happen, I think that would open up a good shorting opportunity. So look for kind of some kind of regulation or some kind of news, right? Some kind of bailout package from Europe that should create kind of a big pop in all the European banks, and then have the same effect here with Wells and all our banks here. And I think that would open up the door to do that.
So basically what I'm looking at is you don't want to be shorting on the lows. And since Wells Fargo's is, and a lot of the other banks are pretty much down here on their lows after a few very stiff, strong days to the downside, probably now is not the best time to be getting short into something in that. That's kind of what I was looking for.
Yeah. I mean, I think if you were to short down, I mean, we pulled it up. It was, it is right at the recent lows. And any kind of news will pop it. Yeah, I mean, the only way that I think you could get short down here is if you're willing to just take heat back to resistance. I mean, if you're comfortable with heat, then you can do it. I think it'll work. If you give it 6 to 9 months, it'll work. But, as traders, I think we can probably try to time it a little bit better. So maybe closer to the hourly 50, if you get some kind of like inverse trampoline using your indicators, I think that would be a good spot to do it.
Now, let's join in on some of the speculation. There's been a lot of talk about now with this starting to happen, what's the Fed going to do about interest rates? They're kind of stuck between a rock and a hard place. I liked your meme the other day about the two buttons. It's like, 25 basis point or crash the economy. And I think Danielle said, how about both? So I think we can pretty much be assured that a 50 basis point rate hike is off the table. That was getting floated around maybe a week or two ago because inflation was still kind of coming in hot. But now we're starting to see that the lag effects of their raising interest rates are starting to take effect. In fact, the Empire State manufacturing numbers came out today. Let's see, I had those when I first started. It was negative 24.6 versus an expectation of -8. So that's definitely a big deal there. I mean, things are really, really starting to slow down internally in our economy pretty quickly. So then, so 15 basis point off the table, and now they're kind of back to, do we stick with the 25 that they were looking for because they want to get to their ultimate, 5 or 5.5 target, and they were going to go higher than expected and stay there for longer, as they keep telling us, or is this where they start to pivot and they at least pause? Now, I don't think that they're actually going to go and back off anything yet. I think the question is, do they pause or do they do 25? What's your thought?
My thoughts, they probably go with 25. That seems like the safest option. I think, the Goldman was saying that they're going to potentially cut, which I think is not going to happen. Not yet, at least. I think if they cut or if they pause, it sends a signal to the market of panic, because then you have to ask yourself, well, what is the Fed seeing that they're willing to cut or pause when they've been so, just a week ago, they were willing to go 50. So it's a little bit of game theory there in terms of like, well, what's the best thing to do in terms of messaging and psychology? And I think it just all happens to kind of the sweet spots at 25 bips with potentially.
Do you think Jerome Powell, we're going to see what Jackson Hole Jerome Powell, where he stands tough and hawkish and actually says, yep, we're here to finish the job. We're going to do this. And you know what? There might be a little bit of carnage along the way, but we're going to do it. We said we're going to reach this target. We've said over and over, we're going to go higher and stay there for longer. So you think 25, they'll be able to actually do it?
I can't imagine we're going to see Jackson Hole Powell again. Maybe ever. Maybe.
That was pretty fun. I got to admit, having him come out there and talk about that was a new side of Powell that we hadn't seen for a long time.
Yeah, no, I would be very shocked if we ever see that guy again. No, I mean, if he comes out at all hawkish, that's going to tank the whole thing, because it's this weird dynamic where the best thing that could happen to markets is actually what's happening now, because a lot of fear is being introduced into the markets that's causing interest rates to go lower, and that actually has a feedback loop of actually helping the banks out of this problem. Um, but yeah, it seems like the happy spot for him next week is probably 25 bips.
Yeah, but it's certainly been interesting watching even the TNX and the TLT. I've been talking about the TLT over the last week and a half or so, and I was noticing that it looked like the TLT, which is inverse of the TNX, wanted to put in a kind of a bottom and a low in through here. And so that's what we were looking at. And then, for me with the Moxie indicator, that's my tool and indicator that I use and, work with the Moxie trading room. But I basically got a buy signal around March 7th, March 8th, and it held on the hourly chart. And then that's what shot the TLT up when everything else started work. So I got to say, one fascinating thing that I love about the market is it's like, truth is stranger than fiction. And also, what came first, the chicken or the egg? Because we look at something like this and the news hadn't broken yet, and yet all the structure of the charts were starting to line up ready for something like this. Sam, what are some of the things that you've been seeing out there as far as these things lining up before the news?
Um, yeah, I mean, I would probably have to agree. The one thing that I think is surprising a lot of people is kind of the inflation trade is getting crushed now. So you're seeing really energy get crushed, and you brought that up to me like last week, I think, where you started noticing before it actually broke down that energy had like this really negative pattern, and then today it was just like complete payoff for anyone who was short that. I'm seeing that same pattern that you were seeing in energy in everything that's inflationary. So industrials have that pattern, energy, materials, banks. So as yields go down, as people kind of panic or are panic buying these bonds, it really takes the shine off of the inflation trade. And then if you look at the price of oil over the past couple of months, it makes me question whether the inflation trade even has ever had any legs, right? Because if the inflation trade was real, wouldn't oil have been going up this whole time? But it's been floundering about for months. So I think a really juicy short going into the summertime is actually shorting the inflation trade, shorting XLI, XLB, XLE, XLF, things like that.
Well, do you think that's because what was happening is people were trying to find where do we go with this? If we have inflation, well, then we go with sectors and stocks that are going to benefit from something like that. But then maybe once inflation runs its course and runs out, and if we do actually manage to conquer inflation, well, we're conquering inflation because we're taking our economy down. I mean, we've talked about this for over a year, that the idea of we knew that inflation is here. We know that despite whatever the Fed says and how nice they're trying to say it, we know that they're trying to send us into a recession in order to get inflation down. So inflation works for a while because it is there and things haven't broken yet. But now if we are starting to actually see things are starting to break, then don't those sectors, as you say, start to become shorts and not work anymore? Well, because now the next thing is everything's going to start getting taken down. We're going to slow our economy. We're going to crunch it. We're going to go into recession. And these sectors might actually start disinflating, as Jerome Powell said 15 times in his last speech.
Yeah, no, for sure. Yeah, I think you could really trade that idea just based off the 10-year. So if you just look at something like TNX or ZN, you can look at whatever bond you want. You could even look at TLT. But as long as bonds continue going higher, rates continue going lower, the inflation trade like energy and materials and industrials has a lot of meat on the bone, because like you've been pointing out, a lot of the tech stuff, like the real bottom of the barrel stuff, like the Pitons of the world and the ARCs of the world, those already got clipped pretty hard, right? Those already got banged down about 75%, 80% off the highs, whereas the inflation stuff is actually still pretty close to all-time highs. So I think we could see something similar to what we saw happen with the kind of the high beta tech stuff start to happen in the inflation trade.
I mean, basically, it's all sector rotation. Money has to find its way around something, and in a bear market, eventually everything kind of has to get knocked down. And we first saw all the crazy names, like you said, the Pelotons. Gosh, what else we had? I mean, just the crazy stuff that was in 2020 was going all through the roof. All the cannabis stock, all the electric vehicle related stuff, just through the roof. And then they got crunched first. And then it worked its way up the food chain to where we saw Apple, Tesla, Costco, Amazon, those started to get hit. And then in place of those were defensives, like, your inflation type stuff that were going up. And now maybe what we're in this final phase, if we are starting to reach the final phase, and keep in mind, I mean, this can still last several more months, but this is the process that we need. We need this stuff to happen. We need the market to be taken down, and we need kind of everybody to be ultimately frustrated in order to lay the groundwork for this. And so the names that maybe got hit first, like I don't know about Carvana, maybe that one won't come back, but names like that, Carvana, Pinterest, Peloton, Fresh, Perch, all those kind of stuff, they have been basing for the last few months. If they continue to base and hibernate during this time when everything starts getting taken down, then when the market finally just gets everything shaken out and everybody shaken down to the ground, and maybe eventually all these bankruptcies and the banks, and we just get all the crap out of the system, burn it all down to where it can start to regrow and we start seeing those green shoots, then maybe some of those early names that have been basing for months and months and months could be the ones that start to spring up again. What are your thoughts?
Yeah, no, I think you've been on that for a while, and I didn't know if I agreed, but it actually makes a lot of sense, and I really like the way that you phrase that everything has to burn down, right? It sounds pessimistic, it really does, but it really shouldn't be taken that way, right? Like the way that you guys should be interpreting this is, one, you're prepared for it, right? If you've been watching our stuff, you've been prepared for this. But then two, it's very similar to like, a forest or something, right? Sometimes trees get too big, they're rotted out from the inside, but they're so big that they block the sun from getting to smaller trees. And one of the best things that can happen to a forest, like TG said, is you have to burn it. You have to clear it out, and that creates the reset for the next big growth. So I think you're onto something. I think that if we start to see the inflation trade kind of burn down, the names that you've been talking about probably go sideways to slightly down. And then by the time this whole thing resets, we're going to reset with, again, very low interest rates. And those names are going to just take off again.
So that's the thing. We just kind of have to bide our time for some of these names. That's why in my presentation that I did maybe 2 weeks ago at this point on March 1st, and I was talking about bullish or bearish, and I was saying, hey, for a lot of this, all these things have already been repriced. The whole job of what the Fed wanted to do was pop the bubble. And for a lot of these names, the bubble has been popped. Now, that doesn't mean they're bullish, but it can mean that they're not bearish anymore. So, the names that are Roku, Roblox, things like that are just down and out, don't trade them to the short side. Unless you got these quick little trades that you can figure out on the lower time frames, they're probably not going to go down much. They could, but, just for the most part, they've kind of done their downtrend. And so they're just going to be hovering sideways, going into hibernation mode. And then what we have to do is watch for accumulation signals coming from them. Watch for some volume, watch for things starting to perk up and work. And they'll just kind of hang out until the market finally says, okay, we're past the bear market. And then we can start watching these things spring alive with green shoots. And I think also part of it is you talk about money. Money right now is being sucked into all the bonds and risk-free assets, because why not? They're getting paid 5% or more. And so we need to think about that is where money's going right now, to hide out and be safe. So money is coming out of equities, and also just because it's a tough environment. So when everything kind of gets burned down again, and you think about fertilizer getting spread on all those green shoots from all the ashes of the big trees that got burned down, think about money starting to come in when interest rates start to come back down, and people are looking for gains, and they need a place to put this stuff. Well, they're going to start flooding back into these low price equities. So it's just the cycle all over again. We just have to be patient and wait for it. And in the meantime, we try and catch whatever trades we can, long or short.
Yeah, no, I think that's really well stated, and it's something definitely to watch out for. I mean, I don't think we're anywhere close to that yet, but once the indices come down a little bit more, I'm looking at minimum 3,500 SPX minimum, and even that's optimistic. But once we start to see kind of the indices come back down, like TG said, you've been seeing a lot of accumulation in these really kind of crappy names, and by the time everything resets, interest rates will be back near zero by the time this is all said and done. And then those names that have been accumulated over months, should probably be the names that lead. So like the Rokus, the Zooms, the Pelotons, the names, all the junk. So that's definitely something to keep an eye on.
Yeah, it'll be interesting to see when the ARK ETFs start popping up again too. So I'm surprised. I think she's been on TV quite a bit talking about things, and she's just going to have to wait it out. There's nothing to do except just wait this stuff out until that sector is ready to go again.
Yeah, and what's interesting is there's a really good potential that after all this is said and done, the next push is going to be like the real one. Like you're going to see just something similar to what we saw during COVID, just from a reasonable starting point for those kind of bottom fisher names.
Yeah. Well, Sam, I think that we've done pretty good talking about the banks and just the